Hi, everyone. Welcome to Crowd Forecast News, episode number 175 for March 26, 2018. Today we will be discussing the 235th weekly report, which you should be seeing on your screen right now while I'm talking. If you haven't had a chance to download the full PDF, you can do that at TimingResearch.com. And for those of you watching live, you should be seeing my new live viewing page on the Timing Research site. But if you'd like to see, or if you'd like to watch it straight from the YouTube page, there's a couple links on that page where you can and then you'll be able to go see the live chat section and ask questions or submit comments during the show. My name is David Kosmeter. I'm the creator of TimingResearch.com, and I have Michael Filighera back to moderate today, so I'm going to go ahead and turn it over to him.
And thank you, David, and thank you for having me back today. And hello, everybody. And today on our panel, we have Glenn Thompson of PacificTradingAcademy.com and Roy Swanson of SteadyTrader.com. And we may get one more participant, but we're just waiting to see if they actually do come in. So we have Glenn and we have Roy and myself. We'll start at the top of the order and go with Glenn. If you would just give an introduction of who you are, where we can find you, and then we'll go on to our questions. So begin with Glenn.
Well, thank you, Michael. Yes, I've been I'm working with Pacific Trading Academy, and you can reach us at that website, PacificTradingAcademy.com. I've been with them for going on, I guess, 15 years now, since the beginning. I've actually been in the industry for, I don't know, 36, 37 years. Started my career as on the sales side as a registered rep with Merrill Lynch. That's how I got into it, and then began to transition to become more active directly related to the markets and trading. I started in equities. Transitioned to the derivative side. Currently, I still trade my own accounts, primarily focused on all time frames in the E-mini and Forex in general. That said, my approach is technical, so I start with the charts. I'm not purposely avoiding an alternate form of analysis, but I primarily focus on charts. As far as my activities with Pacific Trading Academy, I work as a mentor, so I teach all investing and traders, beginners, experts, all segments, wherever you are on your learning curve. And I have a passion for it, so that's what we've been doing, and happy to be here again.
Thank you. And we have Roy Swanson with us from Steady Trader. So Roy.
Hi, Michael. How are you doing?
I'm fine.
I'm the founder of Steady Trader. I've been in the industry about a little over 13, 14 years. Started Steady Trader 3 years ago. We have a very specific mindset, which is to basically get in and out quickly with lots of little trades. Lots meaning somewhere around 20 to 30 every month, holding them for anywhere from 2 to 3, 4 days. But basically looking for very quick, short moves that can be predicted with better accuracy, in our opinion, than longer-term predictions.
Mm-hmm.
And it's all at SteadyTrader.com. We are technically oriented. We don't use charts, however, we're more into using indicators that have quantitative measurements, a little less interpretive. We look for binary decisions based on data. You know, it either hits the mark or it doesn't, and you know, proceed from there with our buying recommendations.
Okay. And again, I'm Michael Filighera. I am the owner and proprietor for LogicalSignals.com, and I began my career in trading in 1979. Here on the Pacific Exchange in San Francisco, where I was an options market maker. I've traded here in San Francisco. I've traded on the London Traded Options Market, and I've also traded on the European Options Exchange, which was located in Amsterdam in the Netherlands. I got my introduction to electronic trading via the DTB, which is the German market, and it really kind of opened my eyes to a lot of potential and possibilities. I came back to the United States, went back down to the Pacific Exchange, and kind of hung out there until things really started to go more electronic overall. And that's when I kind of left the floor and came home to my own office here.
Oops. Is it me?
Looks like he might be frozen. And, Michael, are you there?
I am here.
Oh,
okay.
There you are.
We're good.
You froze for just a
Did I
second.
freeze up?
Yeah.
Oh, I'm sorry, guys. Sometimes that happens when there's a big burst in the market. My computers are so busy collecting data. Sorry about that. Anyway, I came back to the US. I went back down to the Pacific Exchange and started trading there again. And let's get right on to our questions. You guys can hear me, correct?
Yes.
Yeah. Yep.
Oh,
I hear you.
great. Sorry. Question number one. Which direction do you think the S&P 500 index will move from this coming Monday's open to Friday's close? And we'll keep the same order, and we'll start with Glenn.
Sure. This is more of a tricky week for me. Very often I find it a little less taxing from the analytical standpoint to figure out, but I'm going to go with higher. And the reason, I'll elaborate further, but just a brief explanation. Clearly, I see the trend is down from last week, and there are a number of factors, I think. And so the trend is the friend until it's no longer. And I have expectations that 2 days from now, Wednesday, is a particularly important time point. And I think it will correspond and effectively create a turn in general direction and trend. So based on that, I'm going to go again by Friday's close higher than we're currently trading. I think the particular route is such that we're going to go lower between now and the middle of the week, but representing Wednesday as a a pivot point, I would expect by Friday we'll be at a level higher. So yeah, that's
okay. Why don't we just kind of add question 2 right there, is to rate your confidence in the answer?
Yeah,
higher,
I'll give it a little non-committal 65%, let's say.
Okay, thank you very much. And Roy?
Yeah, well, I agree that the the trend is certainly down. We've got a short week this week.
Yes, we do.
So we're not even going to Friday. In fact, market's closing early on Thursday. Basically, I think David told me earlier in the week that this is my 20th show in the last couple of years. This is really one of the tougher weeks to predict because of what happened the last 2 days last week, which kind of throw off technicals, when you have a route like that that's caused not really by technicals, but more by, basically government announcements. Policy. Today we've got the rebound, which is kind of obvious. We're going to have that. It's a Monday. Mondays statistically being good days for the market since 1980, right? A little bit of opportunistic buying happening, but I'm going to stay with the trend and say we will be down by the end of the week. I think this this little opportunistic buying period is going to end pretty quickly today, and then we'll just sort of slog back down to
and
not much lower than it is when it was at the open today, but a little bit lower.
So
my confidence is not super high though, because my confidence is not super high because the technicals were so messed up by the the semi-correction of last week, which always happens to technicals. I'll give it a 60%.
Okay, thank you. I am going to say lower, and I will give my reason as to why in our next section. And I'm going to put a 70% confidence level on that one. The overall response from respondents was 42% higher, 58% lower. And their average of the responses for their probability and confidence was 69.1%. So I think that's pretty high. So actually the lower respondents were above, they were almost at 72%. So that's kind of an interesting dichotomy. So how people want to look at the markets. So question 3 is that for your answer to question 1, please share what specific reasons you think the S&P will be heading in the direction you chose. And again, we'll begin with Glenn.
Sure. Picking up on what I began to mention in my first response, the critical component I have is I've got March 28 coming in as an important time point, and that's based on various cycles that I look at. The same particular set of cycles that I projected a turning point in the broader markets, equity sector on back last month on February 6th are similarly indicating a change or a trend change for this coming Wednesday, 3/28. So it turned out that to the extent I have a similar response by the market, I can expect a change. I almost want to, given your response, Michael, and Roy's response, I almost want to change my answer, my forecast for the end of the week. I forgot I forgot that I didn't even look at the calendar until you guys mentioned it's a short week. So what I'm really feeling now is, will the market have sufficient time, even if I'm correct and the market does respond, that is to say, go down between now and the middle of the week, Wednesday, and then turn around and head northward. Absent that, if what is it? Is Friday a partial session, or are we completely closed? I just realized it's Good Friday. I've completely
closed is Thursday. Thursday at 2 p.m. It's an early close Thursday.
So I might have the right idea, but it might not give the market sufficient time to, even if it were heading northward again, if I were correct, it may not have enough time to cover the distance to realize my forecast. That said, I think I'll play the contrarian card. I don't like I don't like too much agreement. So I'll stick with my projection of higher by Thursday. That's a little, I might want to put that into context, lower my estimate to 60%. But primarily, yeah, that's the key component. All of the fundamental factors, the pure technician of my thought stream is that events as they unfold in the world, they are the effect. The cause is the technicals. And in my case, my perspective is all technicals, all fundamentals, all events as they unfold are responses to certain a given market's running out of time in a given regime, whatever the direction might be, up or down. When the time runs out for a market's move in a particular direction, then there will occur whatever it is that market is sensitive to. If it's a financial market, it might be a press conference by the Fed like we had last week. If it's some other market, it could be anything, this whole spectrum, geopolitical, whatever. And those in turn move the oscillators, and oscillator movements are a function of the price action, not the other way around. But I know this, what is it, tomorrow we have fundamentally, I think consumer confidence comes out, and then Wednesday we've got some type of GDP number. Whatever they will be, I think they're going to push the price lower into my time point again for Wednesday. And then I expect a change. The most prominent and obvious type of change would be a complete 180-degree shift. So that's my logic, my rationale for why I'm expecting more or less a reversal. But again, in consideration of what you guys are saying, and the trend is clearly down today so far. I think we have an inside structure. Technically, that indicates continuation of the type of price action we've seen preceding the inside formation. So all of clearly that trend and a number of the more quantitatively of the technical factors and what I'm reading from the charts do in fact suggest lower prices. I'm just betting that the power of running out of time, which I expect will be congruent with this coming Wednesday, is going to shift it. Whether or not it'll have sufficient time to make up the, go back and retrace, I'll argue and bet that it would, even though we have an abbreviated week. So yeah, it's primarily, again, the pivot point that I'm expecting in response to the market arriving on that timeline to Wednesday, which I think is critical and going to exert a particular motive force to provide some price support. All of the factors, fundamental supply and demand, consumer confidence, whatever, I think will follow and work in concert to bring that about. Yeah.
Okay, thank you very much. That was a great response. Thank you.
Sure.
Very interesting. Roy.
Yeah, well, we look at a few indicators that are a little bit outliers, I think, to the mainstream. One is the RMO, Rahul Mohinder oscillator, which is a pretty modern indicator. It was developed in the early 2000s. Mm-hmm. And there's no indication from that one that the S&P 500 is going to really change direction in a significant way. We like to use some of Wilder's measurements on trends, pretty classical stuff. And there again, we're just seeing the trend is still down. We also have another proprietary indicator that we have developed here at Steady Trader. It's called the Market Pulse, and it's basically a collection of a little over 30 stocks that are spread across all the various indices. We're talking in this show about the one, market index, the S&P 500, but there are other indices, of course, and to measure markets. And one of the things, and I'm not the first person to say this, obviously, but those indices are driven a lot by some of the major players. And what our Market Pulse does, because it's about 35 equities, it gives a different sense of what's happening in the market. In other words, just because the S&P is heading down, a lot of that was driven by Facebook. The big players can really drive those indices. What happens when you look at a bunch of stocks within the indices? And what we're seeing, and this is unusual, is an almost complete lack of what we call cohesion in the market. In other words, are all the boats swimming the same way, or are they all just going their own directions? And right now, we're just seeing everything, no cohesion, everything going its own way, which again makes it really tough to say that the market's going one way or the other. This really, I think, in the next week or so is going to be a stock picker's week. I'm really looking for which moves are going up and down on an individual basis, just because of this lack of what we call cohesion. And that's also why my confidence level wasn't that high. Normally I'd be more in the 70–80% range, but not this.
I hear you. I hear you very clearly on that one, and I don't disagree with either you or Glenn and what you're presenting. For myself, I have been an Elliott Wave analyst for many, many years, over 30, and I still rely on it. Now, just kind of tapping into what Roy said, I think part of what's happening is, yes, we see this fragmentation about a great deal of what was happening in the market at the end of last week was due to the fact that Facebook was getting hit pretty hard, and then that spilled over into Google, into Twitter, and Amazon. And what I saw then was that they started to sell FANG, which is the anagram or the acronym for Facebook, Amazon, Netflix, and Google. And when you looked and you thought, wow, they're doing that, then I looked today, and what are they doing? Buying it all back. Now, you're right. Somebody came in mid-morning and decided that Facebook really needed to get out of, hopefully, or logically, looked like it was a larger position. Now, based on my Elliott Wave count, I think that what we finished was just a part of a larger wave down off of the high at 2807 in the S&P. That being the case, I'm looking for a total of 5 waves down. And right now, the third wave of that is subdividing quite nicely. So I think that we may continue to rally, and in which case, in the S&P, I'd be looking for 2656 to just above 2660. I don't think it's really going to go much higher than that. Now, the second part of that would be timing. If we don't make it up there and the market begins to head lower again, then a break back below 2586 would negate the necessity for any additional upside and would basically announce that the downtrend is back in force. Now, how can all of this balance out when we're seeing that there should be a turn, and what Glenn is saying, and you've got two others are saying, well, the technical side looks like the market should continue to head lower. And I think, again, it's just based on that stocks and a lot of these indices tend to just kind of go their own way. Whether it's actually being manipulated by a larger group, who knows? But again, as we've already heard, the trend is your friend, and so you kind of need to have to follow it, no matter if that trend is just for the next hour and a half. If you're trying to sit back and you're looking at a larger picture, then you have to kind of take that larger trend that's in force right now and build a position or manage your positions according to what that trend is telling you. So it depends on what level you're participating in the market on. But I think that, yes, I think that we can go higher, and I think that they're going to get it all done by tomorrow, which would then signal the trend to reverse and go back into the larger, which is down. So having said all that, I would like to move on to question number 4, which I actually really like. And I'd like to have us, as the panel, spend a little bit of time in looking at this in detail and seeing what answers the respondents gave versus to what we may think. So question 4 is, what do you think are the main reasons why most traders are successful and consistent? What could the average trader do to improve consistency? And again, we'll begin with Glenn.
Sure. It is, I think, a very the critical question. So I agree with your view on this. I think fear is the ultimate culprit, and I think that was listed as one of the choices. When I started trading, I was of what I consider now to be a mistaken belief that if I could only find the set of parameters, wherever they came from, mechanically, that is the ultimate trading system or a set of indicators, the quote-unquote holy grail system, that would be my magic formula to achieve consistent success. Over time, I began to learn that the factors that are more internal in one's emotional state and internal state, framing that and forming that and making sure it's of the right constituency so as to effect a proper reconciliation between you and me, us as observers of market motion, and trying to piggyback on it as efficiently as we can. Ultimately, have a lot more to do than anything mechanical. Anything short of a perfect equation or perfect system that traders en masse utilize, we necessarily need to put our responses, be they intellectual or cerebral and or emotional, we have to make sure that they are on more or less functioning on an even keel. So what I'm saying, it is profound, but it's not a mystery. I think everyone understands this intellectually. Very few traders are able to consistently enact responses to price action and their positions in a manner that reflects that, I think. And so I think that's the biggest culprit. Fear manifests. They actually did a study many years ago that said of the two primary forces responsible for price action, fear and our in our quest for profits and our in the extreme are greed, and account for the two they are the two primary underlying emotional factors that create the forces manifested on a price chart. But they said of the two, fear is 2.7 times more potent than is our desire for generating profits. So anything and everything we can do to put fear and control it. I think the ultimate answer is it's transparent and it's pretty simplistic to comprehend, but moving to enact it and to live it, you have to be detached from any and all financial outcomes. And I always say that to the people I'm teaching. Easy to say, not so much so easy to consistently employ. I didn't say we lose the desire for profits. That's the reason, ostensibly, I guess, we're in the business. But the paradox is being able to detach from financial outcomes, and paradoxically, the more and more you are able to do so, the more consistently the very profit numbers and objectives that we're searching for are going to show up, I think, more frequently. So I think that's the issue. The way towards there, approaching it, is to constantly think in terms of probabilities. A number of writers, have written about this over the years. We are in a realm of probability and information, and so the more we realize it. So give ourselves a grading or a report card, within a window of time that's sufficiently broad. If we resist the urge to evaluate our performance, trade, one trade at a time. We're not it's not a singularity of response. We got to look at it over as a spectrum, a distribution of outcomes, and whatever, even if you're a short-term day trader to a long-term day, position trader, or every time window in between, evaluate it as an outcome. If you have 3 or 4 losing trades in a row, what's your window? That just might be you're getting the losing outcomes occurring on the front end of the distribution. Now, what makes it tricky, obviously, is because our fuel. We're dealing with our resources, our level of equity, and we've got it. That's where the importance of matching your money management, I think, and your comes in, making sure your trade sizing and your risk parameters are appropriate relative to whatever funds you have available will allow as long a run of distribution as you can, so that you're more likely to have the winning trades come up, so as that they can offset any previous and any future losing trades. And that's so really fear is the critical idea. Anything we can do to control it, I think detachment is key. And then in the real world, what that translates to is combining a good set of trade sizing and money management and risk protocols that will combine with your analysis. The analysis is all for the point of finding your edge, but edge implies it's not perfect. I don't have a crystal ball that gives me the perfectly reliable picture of the future. Barring that, this is why we must incorporate some rules of trade size and risk parameter. And if you consistently implement that, and then as a backdrop to that, make sure as much as you constantly strive to be detached. And I tell beginning traders, and I'm speaking to myself also, whenever you're in a trade, think in terms of price changes and returns, and in terms of points and or percentages. If you're not in a position, you can play the numbers in dollars and cents all you want, but to the extent we start thinking about dollars and cents is the extent to which we're more likely to acquire some degree of attachment. And that attachment invariably will work adversely to you. You'll start thinking, your mind will work and think of ways why you should stay in a losing position, and it'll come up with very logical sounding explanations as to why you should stay. Surely the market will turn around. Sometimes it will. And my comment on that would be, you've done the wrong thing. You happen on any given episode to get the right result, but you make a consistent habit of doing the wrong thing, that will ultimately backfire, I expect. So yeah, that's my long-winded explanation. Sorry, I didn't mean to. Yeah, I think anything we can do to create detachment is going to go a long way as a complement to your analysis, and having a good set of money management and risk parameters, I think, will help that process. Yeah.
Thank you. I don't think it was long-winded. I think it was very well stated. Thank you very much.
Right.
Roy.
Yeah, so before I started Steady Trader a few years ago, I consulted for over half a dozen different trading educators for about a decade or so. And you know, what I saw in every company, without exception, is that what happens is that individual traders, at-home traders, they'll get involved with the system and they don't follow the rules. I mean, it's on the sheet here, one of the comments, but it's so true. If you don't follow the rules of a system, the system's not going to work. So I think that's one of the biggest reasons people people have trouble trading. There's a lot of good systems based on technicals, based on data, based on analysis. But if you don't follow the rules, you can't get the result. And there are a lot of reasons for not following those rules. One of them, obviously, is fear and greed. We talk about that a lot. And also being undercapitalized, not having enough capital to actually roll out the system. So I think that in one sense, one of the biggest problems is that if you like a system, if you've investigated a system, you've got to trade it for quite a while to get good at it. That's another thing. People don't put the time in to master a trading system. Whatever it is, whatever the rules are, it's not going to work in 1 week. You know, it might take a couple of years to get good at it. And that's another issue I think that plagues a lot of traders. They'll try a various approach for a couple of weeks, a couple of months, doesn't pan out, and they're on to something else. There's this appetite for always looking for the next new shiny silver bullet that's pervasive in the culture of trading, especially the individual level, and this just serves to undercut a lot of people's ability to make consistent gains. Totally agree with the idea that money management is probably if you look at trading as half of trading is figuring out what to buy, what's the position, what's your system telling you to do, but the other half is the money management. What's the position size? How often are you going to trade? How many trades are you going to make a month? What is the size of your trading account? How long are you holding your positions? We actually we developed an Excel model to put all this together because a few years ago we had this epiphany, which is that every business manager, from the local hairdresser on up to the head of ExxonMobil, they run their daily life and their business based on Excel models, based on budget models with assumptions, and results. And they'll do high, middle, low. This is not rocket science. This is arithmetic. This isn't even mathematics. 90% of traders just do this on the back of a napkin. It can't be done on the back of a napkin. If you don't have an actual model that can plug in numbers like the average gain on your trade, the average number of days you're going to hold it, how many trades you're going to do in a month, what your capital size is for your what the funding is in your account. If you don't plug all that into a model that then spits out the actual arithmetic result, the theoretical power of your system, I don't know why anybody would be trading, honestly. I mean, I hate to be caustic, but like I said, budget models have been out since the beginning of the PC era, in the late 80s and 90s. The local pizza shop has one. And if you're running a trading account without such a model, I don't know. I really don't know how people are making decisions, honestly, without such a tool. So anyway, enough of that rant. But it all comes down to money management in many, many ways.
Thank you. I do not disagree, again, with either you or Glenn. For me, I kind of went through how the respondents, what they were putting down. And some of the ones that really jumped out at me was develop and follow a trading plan. And so I want to start there. And because I do believe a trading plan is very necessary. So I think as a new trader or even as a seasoned trader, you kind of have to have a roadmap of what it is you're doing and why you're doing it and how you intend to achieve certain milestones or goals that you may set up for yourself. So having a trade plan is extremely important. And there are some excellent books that are out there on how you can develop that trade plan, because it's going to be different than a business plan, but it's kind of the same thing. So in other words, it's like you wouldn't start a business without having a plan. So trading, and if you're going to use trading as your sole means of income, or you want to become a professional trader, then you really should have a trade plan, and then you can tweak that plan, but you need to kind of work in following it pretty closely. Now, along with that, I think that both Glenn and Roy were making reference to people coming in with an underfunded account and trying to make, let's say they want to make $10,000, but they're starting with $2,000. Is it possible? Yes, but not on day 1 or 2, probably not even in week 1 or 2 or in month 1 or 2. So it's learning trade plan you really must implement and be very strong on adhering to risk management. I think before someone were to enter into a trade, whether it's a position trade or whether it's a day trade, I think you must determine entry, exit, and what you're willing to risk on this trade. And people get hung up because they hear the tapes playing in their head that may say, oh, the market's going to turn around, the market's going to turn around. As it gets close to your stop, and people don't necessarily want to take that loss, so they either cancel their stop or they move their stop. So instead of actually helping themselves, they've made the situation a little bit more severe for themselves. Now, the thing to remember is that you're going to hear a lot of times that people are going to say the market is always correct. In other words, it's like what is being displayed as a bid and an offer is correct. Now, why somebody is doing a particular trade or coming in to buy at a particular moment or sell at another moment, that's the part where we really can't focus and concentrate on as traders, because there are too many different types of traders that are coming into the market at all given times. And they have algorithms, and they're just out there searching for trades, their computers, finding them, executing, and moving on. So I don't think we, as a trader, can get hung up within why a market is going, who's bullish, who's bearish, more than what's happening right in front of you, and how can you convert that into consistent profits. So trade plan and managing risk are real high on my list. And the second answer that we got on our list was that most traders don't properly manage their positions. And I have to agree with that. Now, whether it's an options position or whether it's a futures position or whether it's a combination of the two, everything is going to require management. And it's also going to have to require, when do you get out of that trade in terms of profitability? And there are a lot of studies that are being done that do you get out at 100% profit or a 75% profit or a 50% profit in a lot of different option trades. On a futures trade, you really have to play it tight. You have to be able to have a trailing stop so that you're not going to get yourself into trouble. And you have to remember your time frame. And more importantly, you must be comfortable and able to accept the risk. So if you're entering a trade and you put your stop in, and your stop is telling you that you have $1,200 worth of risk, should it go up and take out that stop, you're going to lose $1,200. Well, if your account is only $2,000, then that's not good risk management. So learning risk management and position sizing, as both Glenn and Roy stated, is also very, very important, because you can start with $5,000 and have the ability to trade probably up to 3 contracts, possibly even more, depending on margin requirements. That can wipe you out in a heartbeat. So again, position management and also risk management, I find to be very, very important in developing good habits in trading. And not having them is you're not going to be consistent. And what I have the plan, so they don't have an idea, what am I looking to make, what am I willing to risk, and where do I want to put my stop, and how do I want to move that stop. These are all important things that I think you need to know before you pull the trigger, before you get into any trade. And once you're there, the rest of it is really going to fall into place if you just kind of then shift from worrying about the position to managing the position. And I think that those are really kind of important. I personally do not necessarily focus on fundamentals. I focus on start with a larger picture, and again, using Elliott Wave, and I can bring that all the way down to a tick chart. And even tick charts continue to follow Elliott Wave patterns. And if you can do that, then you're going to help yourself out in terms of a market turn, even if it's a 2-minute market turn, but you're going to get yourself into a position where you're going to be able to follow a little bit more closely and then react accordingly. Now, why don't we just kind of go around and give ourselves an opportunity that, using everything that we've said, are there any trade? And I think I froze up again.
Yeah, you froze up again.
We lost you for a second.
Sorry about that. So did you hear that I said what I thought we would discuss now is if I didn't freeze up again. All right. I'm kind of watching my screens at the same time. Okay. Can you guys hear me?
Now we can.
Yeah.
Okay.
You're back.
Why don't we give out a trade recommendation? And let's start with Glenn, using what we've said about setting our trades up.
All right. I like anything or any strategy that would exploit lower nominal treasury bonds, 2-year, 10-year, 30-year. So establishing short positions in the bonds, and just to kind of maybe put it in some context, Michael, to kind of relate it to that from an intermarket standpoint. That's part of the reason I am expecting what I'm expecting to occur in the stock sector. But the trade would be go short in the bonds. How you do it, it depends on the variables that you were just, and Roy, we are all in agreement. You have to factor in, obviously, what's your level of equity, and that in turn ultimately will determine the number of units. But even more precisely, do you trade? Are you a futures trader? Are you an options trader? Are you on the security or derivative side? So what I would suggest to a trader with 50,000 of equity available versus 5,000, completely same idea, underlying and projection and viewpoint and forecast, but might be, look on the surface, superficially, quite, two different things. So we have to find the appropriate instrument, and then from there, the amount of units, and that ought to bear a good relationship to your amount of resources. Also factoring in and integrating your risk reward. And that ultimately gets into, I think, Roy's point, saying, there are plenty of business models and software programs out there. And certainly we want to treat our trading business like any other. And most businesses have cost containment departments. And so in the limit, though, there's still the human element. You can have a program set up or a structure set up, say an appropriate reward risk parameter. But if you violate that, if you tamper with the structure that you've set up in a trade, it could have bad results. But coming back to your question, yeah, I like shorting the bonds anywhere in here to be a little more precise based on the 30-year Treasury. I like the short side of the Treasury instrument market unless and until we take out 145.22 to be very specific. If we violate 145.22 based, and I similarly, Michael, I do Elliott, so it occupies maybe the third tier because trend to me is most important. A close second is my market timing, and thirdly, and that's in the top three things that I analytically that I depend on, is wave structure. If you look at the wave structure of the Treasury instrument on whatever the scale or degree you want to look at, I'm expecting my price target for the next 6 to 8 weeks basis the 30-year is 129. That's my actual level. So I am expecting lower nominal Treasury prices. So that's why I like that. And I think regardless of whatever trader, depending on the amount of funds and what instrument you like, that would be my trade. One way or the other, get short in the Treasury. But it's a position trade. I'm not talking about a day trade here necessarily. There may be opportunities within smaller windows of time to establish shorts or longs, whatever. But again, my window of time, 6 to 8 weeks. I see we're gonna. My target again is 129 basis the 30-year Treasury. So what I would say, or how you would construct that, would be, would resemble. I would need to be informed by the amount of funds a trader has. Or do you buy puts? Do you do a put spread? Do you sell? If a trader has, say, between 30 and 50, I might sell 1 or 2 contracts, and instead of putting in a protective stop, hedge it with an option play or something. The specificity of strategy should reflect the financial parameters of your account. And last but not least, your emotional tolerance for risk. I've worked with traders with very, 7-figure accounts who, interestingly, may have low tolerance they can't tolerate 3% loss on a 7-figure account. Whereas I've worked with traders who have less than 10,000 and they have more of a gambling type mentality. So I always say, start with the numbers, do the arithmetic like Roy was saying. But finally, as a final ultimate filter, ask yourself, and you have to be brutally honest with yourself, if you experience, as a worst case outcome, a loss of a given amount, are you going to be unduly traumatized? If so, you're risking too much. I don't care what the Kelly criteria and all the statistical studies show. To the extent you are unduly upset given any loss, you have to adjust it lower. Not only because of the obvious response that you want to feel good all the time or as much as possible, I'm all for that, but more to the point of the future trading activity. If you have experienced a traumatic loss, it could cause some hesitation in the next time your system generates and proffers a signal, and we can't be selective in the output of our models. Signals. To that extent, you're more likely to, how do you know when the next trade that you're going to do might be the trade that would partially, if not completely, offset some of the previous losing trades? And so we want to remain as differentiated and separate from the model, let it do its thing and find its value when it does. But obviously you have to balance that with the amount of funds. And that's, I think, Roy, and I think we all agree, I think you also mentioned, Michael, the issue of making sure that we're not under-financed correctly, like any other business. That's no different. I think many times traders feel that there's this special factor because we're quote-unquote traders. No, from a money management standpoint, we've got to treat that like any other business and make sure we're vigilant and cutting our costs. But my trade, again, short the bonds, how you would do it would be a function of your level of resource. Well, I would tell very different strategies to different traders. If you don't have at least 50,000 of workable equity, it probably would do some type of hedge, a spread or something. If you have less than 10,000, I'd be, some puts, buying puts or a put spread in something like an ETF that tracks Treasury prices, something like that. Yeah, if that helps.
Thank you very much.
Sure.
Great response. Thank you. Roy, would you have a trade recommendation? And I think I froze up again.
Roy, it looks like you're muted. Are you there?
Roy, what?
Looks like Roy is muted.
Yeah, he is.
Okay, how's that?
Much better, thank you.
Yes, so today we are in DGP. It's a 2x leverage ETF gold miners fund. You know, sort of goes along with what I was talking about, the S&P for the week. We think gold looks pretty good for the next couple of days, and it's doing okay today. We're also in GES, GES, which is up about 5% between Friday and today. Again, and that triggers some really good signals in our system. Hello?
Hi.
Hi.
Is that it?
Yeah, those are my two recommendations for today.
Okay. Thank you very much. For me, I think what I'm going to go with is where my core positions are. Now, for those who know, so I basically day trade the Dow, the NASDAQ, gold, crude, and the euro, and also the S&P. But as a core position, which is something that I continue to carry forward, I am short bonds. So thank you very much for bringing that up, Glenn. And I am long gold. Now, in shorting the bonds, I actually like your forecast, Glenn, very, very much, of 129. In order to get in a position that's really going to benefit you, I think that you want to see the market rally a little bit. And once it does, then you can get into your position. You can use the TLT, which is a 20-year ETF, 20-year tranches of the bond market. And it's an ETF. Check out what the requirements are going to be in buying the options. But most of the time before you enter in, you're going to have to, it'll tell you what you're going to need in margin to carry that position. Again, smaller accounts, you're going to want to use a defined risk type of a spread, and that could be a vertical spread. And in that case, it depends on how you put that spread on. Now, because, correct me if I'm wrong, Glenn, but you were thinking that 60 days out?
For the time window on a short position in the bonds?
For 129, you're looking at how far?
Not 6 to 8 weeks. Okay, hold on. Yeah, hold on. Yeah, and that's and you might find this of interest, Michael, given the Elliott structure. If you look at a 20-year monthly chart, you go way back, and if you can give me a second, I got to bring up a platform. Hold on, but I'm basing that time on an expectation of a perfectly symmetrically formed zigzag type correction off of the top. And hold on one second, if I could bring that up. And then A and the C of a zigzag tend to be equal in length, so that's how I'm getting the price target. But the timing is based on an expectant similar amount of time for the C wave. I think that the bonds are in a longer term C wave. And so, bear with me. Hold on, if I can find my.
Well, while you're looking at that, I'm just going to fill in some of the things. One of the things when I'm putting on an options position is that I try, when I'm initiating a position, unless you're dealing in a weekly. So you have to understand that, and when you're trading options, you've got weeklies, you've got quarterlies, and then you've got monthlies. Now, when you're putting on a spread, you want to give yourself enough time to allow that spread to come into fruition for you. So I tend to look towards an expiration that's going to be at least between 40 and 45 to 50 days out. In that case, you're looking out to the May expiration, which is on May the 18th. Which happens, I think I'm going to do this trade because that's my birthday, and would be a great birthday present. So I would be looking out towards that expiration to put in my positions. Now, volatility tends to be pretty reasonable in TLT. And let me just take a peek at something. Yeah, right now the volatility is pretty low. And so even in the face of a declining market, so you can buy options and you're not going to get chewed up by what we call Vega, which is actually time decay. Because that's something else. When you want to learn to trade options, please contact somebody that's going to be able to help you so that you get a fully understanding, which is why I like to do defined risk, where you're going to be long one option and you're going to be short a different option. And so it kind of offsets the cost and it kind of helps on time decay. So I would use a spread in TLT. Now, if you want to use the opposite, you have the TBT, which is the short bond. This is a long bond and the TBT is a short bond. So the volatility may be higher in the TBT simply because the market has been declining for quite some time right now. So that's why I would kind of come over and use puts in the TLT. So if you were going to use the TBT to put on a vertical spread to take advantage of downside, you would then look to use the calls, but you'd be short the calls. And another trade that I really like is gold. Now in gold, you can use GLD, which is, again, also ETF. The options trade extremely well, as they do in the bonds. Bonds also have enough liquidity, and that's something else to be very, very cognizant of. You don't want to get into a position where the open interest is really low and there's a huge spread and the market trades by appointment, so to speak. So you want to make sure that your options have enough liquidity and that they trade more frequently. So you're looking, your underlying should do at least 1 million or more shares or contracts per day. And the options and the liquidity, you're looking for an open interest up there towards at least probably 5 to 10,000 or more. And they're out there and you can find them. You just have to be careful. Now in gold, I am bullish on gold. And so I'd wait for a little bit of a pullback, which we may get, we may not get, I'm not sure. But I would be looking to accumulate gold. And one way to do that, of course, is just buying the future if you have a large enough account. Another way is going over to GLD, again, using that same principle of giving yourself enough time. And here as well, you're going out into May. So again, it's May the 18th. And you'd be looking to put on a call vertical in the GLD, which would take advantage of an additional rally. Do your homework in terms of making sure that you're giving the market's giving you enough time and room to actually make that kind of a move. So you kind of got to look at past performance, and you kind of got to look at what the structure of a particular rally is. Is it kind of at the top of the rally, or is it in the middle of the rally, so that you know how you want to position yourself. And again, if you, because we're going to go around and just do a closing here, if you want to get in contact with me, you can email me at michael@logicalsignals.com or michael@mjf1partners.com. Either way, I will get that email and then I will respond. If you have any questions or if you want further information about what we're talking about, please feel free to contact any of us. So one last go around. Glenn, how do people get a hold of you?
Sure. First of all, Michael, are we out of time? Because I was able to pull up the bond chart, but if we're out of time, I'll just give my closing. Whatever.
Yeah,
okay. Yeah. All right.
We basically are.
Sure. You can reach us. Go to our website, PacificTradingAcademy.com or PTA.com. Either one, it'll pull it up. Again, myself and some of my coworkers present instruction in all manner of analysis. My focus, again, is on the charts, the technical approach. I work with beginners, experts, everything in between. It doesn't matter what sector, what instruments you like. Because I focus on the technicals, it pretty much allows a broad spectrum of purview of sector, whether you're trading stocks, bonds, commodities, Forex. I've done it all in my career, but I just happen to focus in a more narrow niche area, primarily the E-mini and I'm intraday and Forex. But that said, my instruction is regardless whether you're trading ETFs, stocks, options, etc. I'm happy to accommodate. And then the only thing I don't teach personally is fundamentals. And the interesting irony there, as I started my career, the very first book I read was Fundamental Analysis by Benjamin Graham, but that was 30 some years ago. But in any case, yeah, PacificTradingAcademy.com is how you can reach and learn more about our programs. And I'm happy to work with anyone. Yeah. Very good. Thanks again.
Thank you. And Roy, and you're muted, Roy, so you might want to unmute yourself.
That's right. Okay, so SteadyTrader.com. Please go there, take a look at what we've got. We have strategies for picking trades. We've got tools for doing the money management and risk management component I was talking about earlier. And we also have a free book, Read This First Before You Buy Stocks, which is a really good book about some of the myths that are being promoted by the brokerage industry that every trader should really know about. It's free. SteadyTrader.com, all one word. Thanks for having me on. Always love the show.
Thank you very much for being a part of the show today. And that's going to do it for me. And again, I'm going to turn it over to David. And thank you very much.
Great. Thanks, guys. Great show. Just want to remind everyone watching, be sure to hit the YouTube subscribe button if you haven't yet to get updates on future shows. You can also go to TimingResearch.com to get access to any of the past reports or show archives. And be sure to join us tomorrow afternoon, March 27th, for Analyze Your Trade, episode number 28. That's at the new time of 4:30 p.m. Eastern. Let's see, Christian Fromhertz, Mike Pisani, and Dean Jenkins will be on that episode. And I just want to thank my guests again for this week. Glenn Thompson of PacificTradingAcademy.com, Roy Swanson of SteadyTrader.com, and Michael Filighera of LogicalSignals.com. Thanks, everyone.
Thank you. Thanks. Bye.